Can you lose money in a money market fund? And is it as safe as cash in your bank? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, at the time of this taping on June 17th, 2026, these are the 7-day yields for some of the top money market funds that interest our community. Fidelity's SPAXX at 3.29%. Schwab's SWVXX at 3.48%, and Vanguard's VMFXX at 3.57%. More on what the 7-day yield actually means shortly. So, given that the outlook for interest rates is quite unclear with Kevin Warsh now firmly installed at the head of the Fed, and that quite a few of you park your dry powder in money market funds to remain flexible, here are the 3 topics that we'll be covering today. 1. Which type of money market fund might be best for you at Fidelity, Schwab, and Vanguard? And what does the 7-day yield on money market funds actually mean? 2. How are money market funds structured to protect your money? And 3. Can you lose money in a money market fund? And what other options might you have? Let's dive in now, folks. Which type of money market fund might be best for you at Fidelity, Schwab, and Vanguard? And what does the 7-day yield on money market funds actually mean? Money market funds are a type of mutual fund that invests in highly liquid short-term instruments. The weighted average maturity of money market funds is typically less than 60 days, and generally they're viewed as a low-risk, low-return place for investors to park their money in a brokerage account while waiting for the right investment opportunity to come along. And after a long stretch of very low rates, money market funds have become more attractive again in recent years, after the Fed started raising interest rates post-pandemic. But money market funds are not all the same. Selecting the right one may either earn you a few basis points more and or help you sleep better at night, depending on your priorities. So, money market funds generally fall into 3 different categories: government money market funds, prime money market funds, and municipal money market funds. Government money market funds include the likes of Fidelity's SPAXX, Schwab's SNVXX, and Vanguard's VMFXX. I've included the 7-day yield at the time of this taping for each fund. Please note that yields are subject to change, so be sure to check your broker's website for the latest rates, and more on the 7-day yield shortly. So, government money market funds typically invest in short-term government securities, such as U.S. Treasuries and repurchase agreements that are fully collateralized with government securities. Think of repurchase agreements, also known as repos, as short-term collateral-backed interest-bearing loans. Government money market funds may also invest in agency bonds, which, as many of you in our community know, are sometimes only implicitly guaranteed by the full faith and credit of the U.S. government. Only U.S. Treasury securities are always explicitly guaranteed. And if you want that extra safety from investing only in paper that is backed directly by the full faith and credit of the U.S. government, there are quite a few Treasury money market funds out there as well. Treasury money market funds are considered a subset of government money market funds. Government money market funds are basically as safe as it gets when it comes to the 3 different types of money market funds, and may be a good option for you if you're someone whose first priority is safety amongst all else, over return, for example. Prime money market funds like Fidelity's SPAXX and Schwab's SWVXX invest primarily in high-quality, short-term securities of U.S. and non-U.S. issuers such as certificates of deposits, commercial paper, repos, and bankers' acceptances of non-U.S. Treasury assets. A banker's acceptance is like a post-dated check, a promised future payment issued and guaranteed by a bank. These U.S. and non-U.S. issuers may include corporations, U.S. government agencies, and GSEs. Relative to government money market funds, prime money market funds are generally considered a bit riskier because they hold non-treasury and non-government assets. But on a return basis, they've also historically offered higher yields than government money market funds, although this may not always be the situation. Prime money market funds may be a good option for you if you're someone who's willing to take on a little bit more risk for a little bit more return. And keep in mind that when I speak of risk, my reference point is government money market funds, not other types of investments. In a wider context, even prime money market funds are generally considered safe investments. Municipal money market funds like Vanguard's VCTXX for California and VYFXX for New York usually invest in short-term municipal securities, which are issued by state and local governments. The interest earned from municipal money market funds is exempt from federal income tax, and in some cases, even from state and local income tax, if you reside in that state. If you lived in California, for example, and you bought shares of Vanguard's California-focused VCTXX, you wouldn't have to pay federal or state taxes on the interest earned from VCTXX. Relative to government money market funds, municipal money market funds are also generally considered a bit riskier because they hold non-treasury assets, but they may be a good choice for you if you're someone who doesn't mind the additional risk in exchange for the federal and possibly state tax exemptions on interest earned. Municipal money market funds also tend to make the most sense if you're someone that's in a higher tax bracket, and of course, when held in a taxable investment account, so not a Roth IRA, for example. Remember that because of their tax advantages, the nominal yield that you'll typically see on municipal money market funds will be lower than those on government money market funds and prime money market funds. There's an additional noteworthy item to keep in mind about government, prime, and municipal money market funds, and it's that money market funds, regardless of the type, can sometimes be split into two classes, one class for retail investors and another class for institutional investors. Retail money market funds are for folks like you and me, and typically have low or even no minimum investment requirement. Institutional money market funds are usually targeting corporations, pension funds, and other large organizations, and have a higher minimum investment requirement. There are also some other fairly important differences between retail and institutional money market funds, but we'll cover this in greater detail when we talk about whether you can lose money in a money market fund. And if you'd like to learn more about money and investment topics like what we're discussing here, or if you're interested in seeing what other like-minded, safety-conscious folks are investing in right now for higher yields, come on over and join our VIP investment club, where these conversations are happening every day. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to join us today. And just in time to catch the replay of today's Member Live, where we covered other potentially interesting income opportunities and secondary market bond purchases. I've also linked everything below this video for your convenience. Now, let's talk a bit more about the 7-day yield. The 7-day yield, sometimes also referred to as the 7-day SEC yield on a money market fund, is the average income return over the previous 7 days annualized, assuming the rate stays the same for 1 year. It is typically calculated as the total income of a money market fund minus any expenses divided by the total number of shares outstanding. So, if we look at these 7-day yields here from earlier, all of these are annualized numbers, meaning that this is not what you would earn in 7 days on your investment in any single one of these money market funds. The Securities and Exchange Commission, the SEC, requires money market funds to calculate and disclose their 7-day SEC yield as part of their regulatory filings and in their marketing materials. This allows investors to have a standardized way of comparing the yield in different money market funds. Do keep in mind that the 7-day yield measures past performance and is not a guarantee of future results or outcomes. It usually does change over time as the fund's income, expenses, and assets change. So, now that you know the 3 different categories that money market funds generally fall into, as well as what the 7-day yield on money market funds actually means and is designed to illustrate, let's move on to how money market funds like Fidelity's SPAXX, Schwab's SWVXX, and Vanguard's VMFXX are structured to protect your money. How are money market funds structured to protect your money? So, I'm going to use Fidelity's government money market fund, SPAXX, as the example in this section on how money market funds are structured to protect your money. Because at the time of this taping on June 17th, 2026, if we look at Fidelity SPAXX, Schwab's SWVXX, and Vanguard's VMFXX by asset size, SPAXX is the largest at $456 billion, relative to SWVXX's $390 billion and VMFXX's $378 billion. But know that the same general principle and structure that I'm about to explain using SPAXX also applies to SWVXX and VMFXX, or frankly, all other proper money market funds. So, when you as a Fidelity customer buy $1 worth of SPAXX, your dollar goes into the SPAXX money market fund, and in return, you get 1 share of SPAXX. This SPAXX money market fund is its own entity. It's set up as a separate investment company. SPAXX is subject to regulatory oversight by the SEC with its own fund managers who manage the SPAXX portfolio and who make the buy and sell decisions for SPAXX. Your dollar and the buy and sell decisions from these SPAXX money managers are sent to the custodian, which in the case of SPAXX is the Bank of New York Mellon, BNY Mellon, or BONY for short, and held in trust capacity. The custodian, BONY, holds your $1 and money from other SPAXX investors and uses that money to carry out the buy and sell orders that it receives from the SPAXX fund managers. All SPAXX securities and remaining cash, if any, are held by the custodian in trusts. In addition to holding a money market fund's assets for safekeeping, the custodian may also provide the money market fund with record keeping, legal, compliance, tax, and other services. This setup means that in the event that Fidelity fails, SPAXX as a separate investment company should still be standing, and all SPAXX securities and cash, all SPAXX assets, should still be sitting at BONY in the trust account for SPAXX. Essentially, you would not have lost a dollar. And if, for whatever reason, Fidelity fails and your 1 share of SPAXX is missing, that's when you'd file a claim with the SIPC so that they can replace your missing share of SPAXX. Because money market mutual fund shares held in a customer's account at an SIPC member brokerage qualify as securities under the Securities Investor Protection Act, SIPA, they are subject to the $500,000 limit of protection, not the $250,000 limit applicable to cash. It's important to remember that although investors treat money market funds like cash, they are securities and as such may lose value. In a liquidation proceeding under SIPA, subject to the limits of SIPC protection, SIPC will return money market fund shares to a customer, but will not protect the customer against any decline in the value of shares. Right. Now that we've covered how money market funds are structured to protect your money, let's talk about this part here, about how money market funds may lose value. Can you lose money in a money market fund? And what other options might you have? Money market mutual funds are usually priced at $1 per share, as we showed you in this earlier illustration. You pay $1 for 1 share of SPAXX. This $1 is referred to as the net asset value, or NAV for short. Money market mutual funds try to maintain this NAV of $1, usually by distributing interest earned on portfolio holdings to investors in the form of dividends. Remember when I showed you this table earlier on the differences between retail money market funds and institutional money market funds? Well, there's one other major difference, and that has to do with the NAV of $1. It makes sense that the NAV should fluctuate a bit, sometimes above $1 and sometimes below $1, depending on whether the value of the assets held in a money market fund increases or decreases with the markets, respectively. Because as many of us who own T-bills, longer-term treasuries, agencies, and brokered CDs know, those values usually do change on a daily basis, and depending on the security, sometimes even more often. Well, retail money market funds, which includes government ones as well, are legally allowed to use special pricing and valuation mechanisms to keep their NAV stable at exactly $1. Only if a money market fund's NAV deviates by more than half a cent from $1, the fund would have to reprice its shares to something other than $1. This is known in the industry as breaking the buck. Of course, the most important risks with your money market fund is that some of the investments the fund made will go sour, leading to a loss in the fund's assets and NAV. This was what happened in 2008, when investors panic redeemed shares in the reserve primary fund following Lehman Brothers collapse. The fund held millions of dollars of Lehman debt and eventually had to liquidate after its NAV fell to 97 cents from the mass redemptions, resulting in chaos amongst numerous money market funds. Understandably, to put it simply, breaking the buck for whatever reason, be it actual losses in the underlying assets or just short-term pricing fluctuations, is bad, really bad. And that's why retail money market funds, which includes the government ones as well, are legally allowed to use special pricing and valuation mechanisms to keep their NAV stable at exactly $1 for as long as possible. That's also why you'll very often see a risk disclaimer similar to this one for SPAXX at the bottom of most retail money market mutual fund documentation. You could lose money by investing in the fund. Although the fund seeks to preserve the value of your investment at $1 per share, it cannot guarantee it will do so. Institutional prime and municipal money market funds, on the other hand, must allow their NAV to float, to move up or down based on the market price of their holdings. If the value of these fund shares decrease, investors in these funds will likely lose money, at least on paper. That said, the fluctuations observed for money market funds should be much smaller than for longer dated securities. And most investment managers try to keep institutional money market funds as close to $1 per share as possible as well. The other important thing to note is this. To avoid a run on a money market fund when many or possibly even every investor wants their money back at once, while the fund has its money invested and doesn't have enough short-term liquidity at hand. Basically, to help prevent what happened in 2008 when the reserve primary fund broke the buck following the Lehman collapse, money market funds can manage their assets and outflows in times of market stress in two ways. The first is liquidity fees, meaning an investor is to pay a fee upon share redemption. The goal of the liquidity fees is to protect the remaining shareholders in these circumstances and to more fairly allocate costs so that the redeeming shareholders bear the cost of selling their shares. So, in an ideal world, those wanting their cash back would pay enough in liquidity fees so that the share price for the investors that remain in the fund can stay stable at $1. All money market funds are permitted to use liquidity fees when and if necessary. In fact, most money market funds, including retail, prime, and municipal money market funds, must charge a liquidity fee to redeeming investors if the fund's board determines that a fee is in the best interest of the fund. The one big exception from this obligation to charge liquidity fees are government and U.S. Treasury money market funds. They can choose whether they want to charge liquidity fees or not, as disclosed in their fund prospectus. So, as an example, if we go back to the SPAXX risk disclaimer from earlier, we can see that SPAXX, as a government money market fund, explicitly states that they will not use liquidity fees. Fidelity's government and U.S. Treasury money market funds will not impose a fee upon the sale of your shares. The second lever, permanent suspension of redemptions, is another way that money market funds can use to manage their assets and outflows in times of stress. Under certain, and in my mind, I would think extreme conditions, money market funds are allowed but not required to permanently suspend redemptions and close out the fund so that an orderly liquidation can occur. There are also provisions in the regulations on how a money market fund could deal with negative interest rates. Now, the U.S. has so far never seen negative interest rates, so we won't dive deeper into this topic. But in essence, money market funds could react to negative interest rates by either converting to a floating share price or by reducing the number of their shares outstanding to remain stable at $1 per share. Having said all this, money market funds under normal circumstances, when there is no market stress, are still low risk when compared to other mutual funds and other investments, hence the historically lower return. Nonetheless, it's important to understand that as low risk as they may be, money market funds are not cash, and in some fairly extreme circumstances, they may lose value or become less liquid than most investors perceive. Now, personally, with the data that we have, this does not worry me and Marcus so much. But if you're genuinely concerned about your money market fund shares breaking the buck, or about the liquidity issues that may arise in times of market stress, or if you decide for any other reason that money market funds are just not for you, one truly safe option for you may simply be real hard cash sitting in a high-yield savings account at an FDIC member bank in amounts below the FDIC threshold of $250,000. Remember, though, that while interest earned in a high-yield savings account is fully taxable on a federal, state, and local level, earnings on some of the money market funds that we've talked about today, those that hold treasuries and or municipal paper, may be fully or partially exempt from federal, state, and or local taxation when held in a normal taxable brokerage account. Everyone's financial journey is different. What about you? What are you doing with your money right now? And where have you parked your excess cash? Drop a comment below and let me, Marcus, and everyone know. And as always, if at this point you're interested in joining our daily member conversations and regular deep dives into other potentially higher yielding investment opportunities, come on over and check out our VIP investment club. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more and join us today. I've also linked everything below this video for your convenience. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.